Welcome back to Personal Pension Radio. I am Craig Strom, the income engineer. And if you haven't already listened to episode 261, I did go off a bit on bad pension advice from the big doctor, the big Dave Ramsey himself. If you're blessed to have a pension, you have got to check that out. Episode 261. This time I actually want to talk to you about whole life insurance, cash value life insurance. This is such an important topic that gets missed because Wall Street doesn't like to talk about things that take money away from Wall Street. So I want to make sure to cover this in a bit more detail because someone listened to an episode recently where I said that canceling an old established whole life insurance policy might be the dumbest move. It was an old episode where I'd actually relayed this story on one of the big doctor's podcasts where he gave that advice like, yeah, maybe you should just cancel that old whole life policy. I'll never forget it. I about jumped off the ship. I was on a cruise on vacation listening to the podcast, the Dave Ramsey show in my headset. Horrible advice. And I want to make sure to go through this in a bit more detail so that you know why my answer is no, it's probably the dumbest move ever. You've got to hear this. Now, first, is cash value life insurance a bad place to hold money? Notice that I didn't say invest money. Cash value life insurance, if it is designed correctly, is a very conservative place to hold money. It is not an investment. For the record, in a cash value life insurance policy, let's say a whole life insurance policy from a mutual life insurance company, there is no record in the history of mankind of anyone losing money on a cash value whole life policy because all of a sudden the account value went down. It doesn't happen. They are an extremely conservative asset. You'll hear more about that in just a moment, okay? But again, I am not talking about indexed universal life. I spoke about that on a previous episode just recently. I'm not talking about indexed universal life. I'm talking about good, old established mutual whole life insurance companies. Not all cash value life insurance is created equal. Some I am not a big fan of. Some cash value life insurance policies, in my opinion, are sold wrong. They're sold for the wrong reasons and they're sold to the wrong people by uneducated financial advisors that just pitch whatever they're being told to pitch. I do believe that there are some cash value policies that are just they're just bad for the market in general. They give financial planners like myself who believe in the proper use of cash value life insurance, they give us a bad name, and they give people like financial entertainers, they give them fodder to be able to go out there and say, see those terrible cash value life insurance policies, and they lump them all into one big pot, but that's not the reality of it, okay? Now, I want to reference some very important data here, right? Because as we talk about cash value life insurance, it's really important to understand what type of an asset this can be. And I mean it, an asset class. So I want you to think about this because you have financial entertainers out there like Dave Ramsey that say, life and cash value life insurance is the spawn of the devil and you should never have it and under any circumstance whatsoever. It's a terrible, terrible, terrible thing. And any financial advisor who might ever suggest it is a horrible person, basically. That's my words, not Dave Ramsey's words, right? Okay, so let's cover this though. Let's cover this just for a quick sec. Wells Fargo Bank, on line 41 of their balance sheet, line 41 on their balance sheet holds just under $20 billion in cash value inside cash value life insurance. Wells Fargo Bank, $20 billion. Bank of America. Bank of America holds $23 billion in cash value. Not death benefit, folks. $23 billion in cash value inside cash value life insurance. Let me ask you this. Does the bank ever do anything that's not good for the bank? Comment below, by the way. If you're watching this on YouTube, leave me a comment. I want to get some comments going on that. Does the bank ever do anything that's not good for the bank? Well, of course not. In my opinion, the banks never lose, right? So why in the world would they have $20 billion in such a terrible place to put money? Do you think maybe the right kind of cash value life insurance is actually a pretty legitimate and pretty good asset? Maybe. Yes. Now, my favorite, there are a number of these, but my favorite that I looked at recently was Zions Bank. So Zions Bank is actually based in Utah, and they actually have a contract with Dave Ramsey's organization to provide Financial Peace University. Now, I've said it in the past, Financial Peace University offered by the Ramsey companies is actually a really solid, fundamental, basic money class that you can take at your local church or community center, or in this case, at a bank. They teach some really good fundamentals. There are some things that the Financial Peace University teaches, I think, that go a bit beyond what they should be teaching. It's a bit vanilla, but it's also giving out some really solid, like no options other than this type of advice that I think isn't appropriate. It actually, financial planning is flexible to each individual person, but certain things I don't agree with, such as life. But getting back to this original idea of banks with this terrible cash value life insurance on their balance sheet, well, Zions Bank has a relationship that they provide Financial Peace University with the Ramsey organization. They must not have any cash value life insurance on their balance sheet, right? Because that cash value life insurance, that's just terrible stuff. Terrible place to put money, right? $532 million. This is a small regional bank, pretty large, but regional bank. $532 million on their balance sheet. That is incredible. My favorite, right? Because they're actually an FPU partner, and there they are. I remember one in the past that was the same thing, right? Another bank has $1.6 billion in cash value, and they offer FPU. Now, enough about that, okay? Because the type of life insurance is very important, right? That is the key. That banks hold cash value life insurance like that, and then oftentimes it's a mutual company whole life insurance style policy. It is an asset class that the Federal Reserve considers to be among the safest places that a bank could hold the money, and they keep it on the balance sheet. Line 41 on the balance sheet. Check it out. You can look it up anytime. So the idea is that the life insurance on the bank's balance sheet is there as an asset class, right? But if you really look at it in retirement income, the balance, the death benefit, right, and the cash value can really actually weigh into a retirement income plan if you use it correctly, right? So I spoke to a client recently about their existing, mind you, an existing whole life insurance policy. The death benefit on their policy, they've had the policy for a long time, the death benefit on the policy is $750,000, and they have over $300,000 in cash value. Now, the policy is now self-sustaining, meaning that it has enough cash value. It is an equity asset. It means that they have more cash value inside the policy than what they actually put in. And it is self-sustaining in that dividends and interest earned on the life insurance policy, they service that, those things service the ongoing premiums, so they don't have to pay any premiums. The policy is servicing itself, and because it is a mutual whole life policy, it is going to continue on for the rest of their life doing that. So here we have a $300,000 cash value account that they could use it if they wanted, but they have a $750,000 death benefit. Now, this is the key. And I've heard financial entertainers like Dave say this, that, well, you don't get that cash value when you die. Well, no, you don't get the cash value when you die because you're dead. Your family gets $750,000 instead of $300,000. What investment account can do that? What investment account can take $300,000 in a conservative asset and immediately is the key, and turn it into 750 grand? And I say immediate because could you have invested, $100, $1,000 at a time over the last 20 years, and yeah, you get 750? Sure, you could do that. What could you do that's going to guarantee that? Cash value, whole life insurance. Now, the compliance folks would want me to say it's guaranteed by the claims paying ability of the insurance company. Yes, that's true. But here's the thing. These insurance companies, these mutual whole life insurance companies, they have been profitable in some cases for 100 years, 150 years, 200 years. They don't lose money. So I'm not sure how much more secure you could be in a secure asset. Oh, that's right. The Federal Reserve considers cash value whole life insurance to be among the safest places that banks can hold reserve money. Right? All right, enough about that rant. But let's look at an example, because the life insurance here in this case is $750,000 death benefit with $300,000 of cash value. But how do we use the life insurance for these folks? Because, by the way, full disclosure, it's not my life insurance policy that I helped him get, but I was the first one to say, whoa, don't do anything with that life insurance policy. Leave it alone. Let me tell you why. Let's look at an example. They have $500,000 in a 401k account. At the recommended 4% draw rate, that equals $20,000 a year. If you haven't listened to my episode just on this podcast alone, 262, go check that out, the 4% draw rate and the details behind that. So I'm going to assume that you've gone and listened to that 4% draw rate episode, and I'll keep going. $500,000 in a 401k at a 4% draw rate is 20 grand a year, right? Simple math. If we use the standard Wall Street Monte Carlo simulation, there will be about an 85% chance that they won't run out of money if they do a 4% draw. Think about that. An 85% chance means there's a 15% chance they could die broke if they try the 4% rule, right? If they don't die broke, they might leave some of that money, that 401k money behind, $500,000. Now, or they give the $500,000 to a life insurance company for an income annuity, basically a personal pension, an income annuity, where you give an insurance company the money and they guarantee to pay out an income stream for as long as you live. Okay? The company pays out an income stream. Now, the income annuity pays out a guaranteed income, yes, guaranteed by the claims paying ability of the company. And nowhere in the history of mankind has anyone missed a guaranteed annuity income payment. Ever. Never happened. Find me a statistic, a detail, anything that proves differently. Send me an email, Craig with a K at craigstrom.com. But we'll just assume that it's never happened, because in 20 some odd years, I've never found an example ever of an insurance company missing a payment. So let's call it a guaranteed income stream, guaranteed by the claims paying ability of the company. Now, the income annuity, though, pays based on mortality. Yes, there's an interest component and such, but it pays based on how old you are. Okay? And instead of a 4% income rate, these folks get 6.5%. 6.5%. So they get $32,500. Stay with me here, folks. This is so important. We're talking about the 401k. Don't forget, hiding in the background is that life insurance policy that these folks asked me first, hey, should we cancel that or maybe spend that $300,000 of cash value? And what did I say? No, 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 no. Let's look at an example, okay? So we've kept that in the drawer. Wait on that. $500,000 401k, okay? 4% income. Yay, $20,000 a year. Or 6.5% guaranteed, no risk. It will pay out as long as husband and wife shall live. $32,500. That is a huge difference, right? That is a huge increase, a 35% increase in their retirement income, right? Okay, good. Here we go. But what about the poor children? The poor children who won't inherit any of that $500,000 401k money because mom and dad made a decision to take maximum income from that $500,000 pot of money. They took maximum income, and when both of them die, the income stops. What about those poor, poor children? Well, the children, they'll have to suffer through receiving a $750,000 paid up life insurance policy. Income tax free, right? I think they're going to be okay. In this case, the life insurance paid up. It was a good asset. They could use the $300,000 if they wanted to. They could draw from it with loans and dividends. They could do a variety. They could whatever. But really, the part that got missed was the death benefit was seriously a permission slip for mom and dad to spend the heck out of the other money. Could they also, if they wanted to, remember, they were talking about a $500,000 401k. What if they took some reverse mortgage money out of the house and spent that too? Do you think the kids would still be happy to receive a $750,000 income tax-free life insurance policy for mom and dad? Exactly, folks. That's the point. The life insurance was not the answer. It was not the answer to this retirement income scenario. It was just part of the overall plan. So they are definitely keeping that life insurance policy, stick it in the drawer, and use it as a permission slip to spend the other assets as they so choose. If you have questions about your retirement income plan, send me an email. Craig with a K at craigstrom.com. Craig with a K at craigstrom.com. Be sure, if you're watching on YouTube, please subscribe. Please hit the like button, the comments, all that good stuff helps a ton. Really appreciate it. Talk to you again soon.